Next, we will do the budgets for the purchases of direct materials, the use of direct labor, and manufacturing overhead. Each of those budgets begin with the production in units, not sales in units. So for example, we expect to sell 20,000 units in April, but we need to produce 26,000 so that we will have those extra units. So each one of the three next budgets will begin with 26, 46, and 29, and sometimes we'll need that extra month for July. So I'm going to copy the production in units. I'm going to go to budget 3, the materials budget, and I will fill in the 23 for July. I will then go to budget 4, the direct labor budget, and I will fill in the 26, 46, and 29. I will then go to the manufacturing overhead budget and also fill in the 26, 46, and 29. Okay, let's go back to the materials budget. There are 5 pounds of materials needed for each unit we produce. Again, I put in capital letters here. We start with production in units, not sales. What I will do first is I will add April, May, and June together. So the quarter needs 101,000 units. It takes 5 pounds of materials per unit as given. So I will multiply the units produced times 5. And I'll do that for May, June, quarter, and July. Now, in this case, they want a desired ending inventory of materials, and our materials comes in pounds, of 10% of the next month's needs. So similar to what we did with the production budget, I'm going to add desired ending inventory and take out beginning inventory. So desired inventory will be 10% of next month's needs. So 10% or 0.1 times next month's needs are May's 230,000. So 0.1 times 230,000 is 23,000. For May, I'll take 10%, 0.1 times June's needs are 145,000. Now for June, I will take 10%, but make sure that you pop out here to July. I need 10% of July's 115,000. Don't take 10% of 505. That's the quarter. I want 10% of July. Okay, I'm going to draw some arrows in just to point where we got the numbers from. And again, notice that it is 10%, skip the quarter, go out to July. Okay, I will add the last two numbers together for total needs. Now I'm going to come back to the quarter column at the end. Okay, so less beginning inventory. Let's come back to April. So like with the production budget, the ending will be next month's beginning. So the end of April, April 30th is 23,000. So that will be the beginning May 1st. May 31st, the end of May is 14,500. So that will be June 1st. And again, I'll do the quarter column later. Now, like with the production budget, the ending inventory is 10% of next month. The beginning inventory, looking at May's, for example, of 23,000, is 10% of May's, the current month's 230,000. So therefore, for April, I will take 10% of the current month's needs of 130,000. Try that again. I don't think I got the 10% in. About 0.1 times 130,000 for $13,000. Now, beginning inventory you have on hand, so you subtract it out. Okay, next we will finish the quarter column, but let me draw some arrows in again to show where the numbers came from. Again, I just bring the end of the previous month down to the beginning of the next month. And this 13,000 came from taking 10% of 130,000. Okay, next, let's finish out the quarter column. It's a little bit different. Keywords. If you see the word ending or you see the word beginning, that's the hint that you're not adding the row, but you're taking the beginning or ending number for the quarter. So end of quarter is June 30th, 11,500. Beginning of quarter is April 1st, 13,000. So again, if you see the word beginning or ending, don't add the row, bring over the ending for when it says ending, and bring over the beginning for where it says beginning. So I brought over the 11,500 and the 13,000. Okay, to finish it out, I'll go vertically, add 505. Try that again. Add 505 plus 11,500. And then 516,500 minus 13,000. Now it says the cost is 40 cents a pound. So I'll put 40 cents across the board. Okay, for budgets, I need it as a dollar amount, not number of pounds. So therefore, I will take the last two numbers and multiply them. So 140,000 pounds times 40 cents is $56,000. Okay, I'll do the same for May, June, and the total column. Okay, and I did get my check answer of 201,400. Now, we buy our materials on account, so the cash outflow does not happen immediately. We get a little time to pay it. So the cash outflow consists of paying half in the current month and half in the next month. It does say the March 31st balance owed is $12,000, and so we'll bring that in as our April 1st balance. Okay, for April, we expect to purchase $56,000 worth of materials. So 50% of that, of the 56,000, will be paid in April, but the other 50% will be paid next month. So it will be paid in May. Okay, so 50% of 56,000. Try that again. And in May, again, 50% of 56,000. Okay, and I will bring these over to the total column. Okay, May purchases are 88,600. 50% of the 88,600 will be paid in May, and 50% of the 88,600 will be paid in June. Okay, 50% is 44,300. So 44,300 in May, 44,300 in June. Bring it over to the quarter column. Okay, for June, 56,800 of purchases are made. So 50% of the 56,800 will be paid in June. Now, like with the production budget, I don't care about the other 50% because that will be paid in July. So 0.5 times 56,800, and then bring it over to the total column. Okay, now I will add my columns. 12 plus 28, 28, 44, 3. And if I add vertically or horizontally, it's a good way to check yourself, by the way. I do get the check answer as well of 185. So even though we're buying $56,000 worth of materials in May, our cash outflows, our cash payments for those materials will only be $40,000. Okay. At some point it catches up. For example, in June, we only buy 56.8, but we have a cash outflow. We pay for 72.7 because we're paying for some of those previous purchases that were on account. So this payment for materials, I'll highlight in blue, and keep in mind we want the cash payments, not the total cost. We want the cash payments for materials. These numbers will be our first cash outflows on our cash budget. So I will copy these. I will go back to budget 7, my cash budget, and right here under disbursements. So again, I'm on budget 7, my cash budget. Under disbursements, my material purchases, or I should say my materials cash outflows. Are copied into the cash budget. Again, I want to point out that as you're looking at the material budget, don't take the cost of purchases, take the cash payments. When are you actually paying the cash for them? Okay, next, our second production cost is direct labor. Several different scenarios could happen here. In this case, each unit requires 0.05 direct labor hours. So again, what I've done is I copied down my production in units from my production budget of 26, 46, and 29. I'll go ahead and add it together. I'll take each one times 0.05 hours. Okay, I already did April. I'll do May. I'll multiply 46,000 times 0.05. Do June. And do the quarter. Now, there could be different scenarios. They may pay overtime or they may not. They may have a no layoff policy. In this case, there's a no layoff policy. They're guaranteed to get paid for 40 hours at $10 an hour. So even if they work 35 hours, they still get paid for 40 hours. In exchange, if overtime is worked, instead of time and a half, normally overtime would be 1.5 times that $10, or in this case, $15. They get paid for the extra hours, but they just get paid at $10 an hour. So if each employee works 40 hours, that is a guarantee that we have to pay for 1,500 hours. Even if we didn't need them for the full 1,500, we have to pay them for 1,500. Okay, so look at what happened here. So our guaranteed amount is 1,500. Let's bring down. In April, they worked 1,300. I'll bring down in May, they worked 2,300. And in June, they worked 1,450. Now I compare these two and I bring down the largest for payment. So for example, I have to pay them for 1,500 in April, even though they only worked 1,300. They did work more than the 1,500 hours, so I have to pay them for 2,300 in May. And in June, they worked 1,450, but I have to pay them for 1,500. Okay, so I brought down the guaranteed amount of 1,500, 2,300, and then 1,500. The rate is $10 an hour. So I'll multiply each one times 10. Okay. In the total column, I'll add up the total number of hours and take it times 10. I can also add going horizontally, and I should get $53,000 as my check answer for this problem. Now, in the one you'll be doing, I'm going to show you the scenario changes a little bit. What if you do pay them overtime for anything over 40 hours? And let's say April production, you came up with 39,000 units, and the direct labor is 0.8 hours per unit. So that's 3,120 hours. Now, if every employee works 40 hours, let's assume that's given to you, that would be 2,000 hours. And let's assume the regular rate is given to you at $15. Okay, so if they work 3120, regular rate is at 40 hours, 2,000 hours for all employees. I'll take 2,000 hours times 15. Regular pay is $30,000. Now, if they worked 3,120 hours, anything over 2,000 hours, they get overtime pay for. The regular rate is $15. $15 times 1.5. The overtime rate is $22.50. How many hours of overtime did they work? 3,120 minus the 2,000 regular pay. 1,120 was overtime. 1,120 times 22.50. Overtime is 25,200. Next, I'll add the two numbers I have highlighted in yellow. 30,000 regular pay plus 25,200 overtime is 55,200. Now, if they worked under 2,000 hours, I just pay them for $15 for however many hours they work. Let's say it's 1,000 hours. So 1,000 hours times 15, 15,000. And there would be no overtime. Okay, I hope that helps you out with the production budget, or with the direct labor budget that you'll be doing for your homework assignment. Next, we'll move on in the next video to manufacturing overhead budget.